EPK Capital presents Daily Brief for 28th October 2025. Hello, and welcome to EPK Capital's Daily Market Briefing. I am your AI host, Rutvik, bringing you the most critical financial news and analysis from the last 24 hours. What a day for the bulls. Markets didn't just climb, they exploded to new all-time highs. The S&P 500, the Dow, and the NASDAQ all closed at new records. So, what fueled this massive risk-on rally? And why did safe havens like gold get crushed? We're breaking down all the major macro drivers from the last 24 hours, including the huge political comments moving the needle, the major stock winners and losers, and a big breakout in the crypto market. Let's get right into the numbers. The closing bell, a sea of green. It was a powerful session on Monday, extending the rally from last week. The S&P 500 finished the day up 1.2%. Closing at a brand new record. The NASDAQ Composite was the star performer, soaring 1.9% to its own all-time high. And the Dow Jones Industrial Average joined the party, gaining 0.7% to also secure a record close. This wasn't just a U.S. story. The optimism was global. Asian markets saw strong gains, with Japan's Nikkei 225 jumping 2.5%, and European indices also pushed into record territory. So the big question is, why? Driver number one, the U.S. China trade deal. The single biggest driver yesterday was a massive wave of optimism regarding a U.S. China trade deal. Investors are looking ahead to a critical meeting scheduled for this Thursday between U.S. President Donald Trump and Chinese President Xi Jinping. The rhetoric leading up to this meeting has been extremely positive. The key political comment that markets seized on came directly from President Trump, who told reporters, "We feel good about working things out with China." In market terms, this is interpreted as a very strong signal. The consensus is shifting from if a deal will happen to when. Investors are now pricing in a best-case scenario, a significant de-escalation of the trade war, which would remove a major headwind for global economic growth. Driver number two, the Fed is ready to cut. The second major tailwind for stocks is the Federal Reserve. The Fed's policymaking committee, the FOMC, meets this Wednesday, and the market is almost unanimous in its expectation. A 25 basis point, 0.25% interest rate cut. This expectation was locked in by recent inflation data, which came in a little cooler than expected. This tepid inflation gives the Fed a green light to continue its easing cycle to support the economy, and the market loves cheap money. These two factors, trade optimism and expected rate cuts, create a Goldilocks environment for stocks. And that's exactly what we saw play out. Macro data, where did the money move? We can see this risk-on story clearly in other assets. First, in the bond market, the 10-year Treasury yield actually ticked lower to just under 4.0%. Now, usually when stocks rally this hard, yields, which move opposite to price, go up. The fact that they fell slightly tells us that bond traders are still 100% convinced the Fed will cut rates on Wednesday. The U.S. dollar index DXY also slipped about 0.1%. A weaker dollar is a direct result of the market pricing in those future rate cuts. The most dramatic victim of this risk-on rally was gold. The classic safe haven asset tumbled 3.2%, falling back to around $4,005 an ounce. This is pure profit-taking. Gold recently hit a record high above $4,300. Yesterday, investors sold their insurance, gold, and piled that capital into growth. Interestingly, WTI crude oil didn't join the rally. It actually finished the day slightly down 0.3% at $61.35 a barrel. You would normally expect trade optimism to boost oil prices, since a better economy means more demand. But it seems oil has its own supply-side factors that are keeping a lid on the price for now. The big stock movers. Now let's look at the companies that made headlines. The biggest winner in the S&P 500 was Qualcomm, QCOM, which soared 11%. This was a massive move. The company announced it's launching new AI chips for data centers. This is a direct shot at the current market leaders, NVIDIA and AMD, and investors are betting Qualcomm can carve out a piece of the extremely profitable AI hardware market. The second big winner was Tesla, TSLA, which jumped 4.3%. This rally was sparked by new analyst notes, particularly from Morgan Stanley. They suggested that Elon Musk's recent comments on the robo-taxi program imply that Tesla has effectively solved full self-driving technology. On the losing side, the The S&P 500's worst performer was Albemarle, ALB, the world's largest lithium producer. The stock dropped 8.9% after it announced it was selling a controlling stake in its Ketjen refining catalyst business. And, in a move that should surprise no one, gold miner Newmont, NEM, sank 5.7%. This is a simple equation. When the price of gold plummets 3.2%, the companies that dig it out of the ground fall even harder. Crypto Corner, Bitcoin breaks out. Finally, let's look at the crypto market, which had a very interesting day. While gold was selling off, Bitcoin, BTC, did the opposite. It rallied to trade near $115,000. From a technical perspective, this is a significant move. Analysts are calling this a breakout to a new 2-month high. Bitcoin managed to smash through a key downtrend line that had been holding it back. This is a fascinating divergence. As investors fled the traditional safe haven of gold, they appear to have moved into both stocks and Bitcoin. The new support level to watch is around $113,500, with the next major resistance target at $116,000. The week ahead, it's just getting started. As big as Monday was, this week is just getting started. We are facing a gauntlet of market-moving events. On Wednesday, we get the official interest rate decision, and more importantly, the press conference from Fed Chair Jerome Powell. This is also a monster week for earnings. Microsoft and Alphabet report on Wednesday, followed by Amazon and Apple on Thursday. That is all for your market update. We will be here to track it all. Thank you for watching. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice.